I think that we have a situation where the housing market will generate a dead weight, which will pull us further down. The worst recessions we have are when we see when we have the housing market is actually also crashing or has a downturn. And this time around, it seems like we can have one that is really severe. So I think the housing market is more that dead weight loss, that when the labor market finally gives, and I think it will soon, then you'll see that that will be pulling us down further. These are the things that can exacerbate the severity of this crisis. And I think we're seeing that again. Not the kind of speculation, but it's something that will be weighing in heavily on the balance sheet of the banks.
Over the past few years, financial markets have defied expectations, climbing to new heights despite global uncertainty. While some analysts have warned of an imminent collapse, others remain skeptical, pointing to strong economic indicators and continued resilience in equities. But beneath the surface, troubling signals are emerging, signals that suggest we may be heading towards something far more severe than a routine market correction. According to macroeconomist Henrik Zeberg, we are not at the final peak just yet, but when the real crash arrives, it could mark the beginning of a profound monetary reset. One of the key drivers of this coming crisis, Zeberg argues, is the fragile state of the U.S. housing market. Although home prices remain high, a dangerous imbalance is developing. With an oversupply of homes, rising financial strain, and homeowners locked into low-interest mortgages, transaction activity is grinding to a halt. The real danger, however, lies in the potential for widespread job losses. If unemployment begins to rise significantly, homeowners will struggle to make ends meet, leading to forced sales and a sharp decline in home values. This cascading effect, combined with existing vulnerabilities in the financial sector, could trigger a deep and prolonged recession. Beyond housing, broader economic indicators suggest that we are in the late stages of the current market cycle. While European and emerging markets have shown signs of strength, Zeberg warns that this is likely part of a final, euphoric rally before the inevitable downturn. He believes the true crash will not be driven by speculation alone, but by fundamental imbalances in the global economy. As central banks attempt to manage inflation and financial stability, the risk of policy missteps looms large. The key question now is not whether a crisis is coming, but how soon and how severe it will be. As we present clips from Henrik Zeberg's interview with Commodity Culture, please watch, share, and like this video, subscribe to the channel, and turn on the notifications bell for instant alerts when we upload. We appreciate the support and hope you enjoy the video.
Let me start out with why we're not there yet. I mean, we're not at the top that I expect to come in yet, and it's taking longer than I fully take that in. And people are starting to say, "Oh, Henrik, you're right on that. We have the crash now." And I'm saying, "No, guys, it's not really it." And why do I say that? Because the economy hasn't rolled over. So the thing is, and also if you look to Europe and elsewhere in Asia, and you look to the Hang Seng Chinese index and so on, you actually have quite emerging markets. Also, you have quite strong bounces there. So, and the DAX made a new high yesterday. So people are saying you have the market crash, and then you should expect that the market in Nasdaq would be topping out in December. DAX making a new high here mid-March, and you have no indication in the yields that we actually have a recession coming very soon because the yields are staying high. They would normally plummet before that. And I have other indicators as well. So people are again this is just freaking out. There's simply no way that this can be put up in a way where the puzzles or the pieces can fit together if this was the big one. So that's what I'm saying. This is not the big one. We haven't seen the Fibonacci extensions that I also have to lift. I mean, because so much time has passed, I have to lift the extensions, which means or the target actually to a little higher level for the S&P. And so I don't think I don't see it's here. We simply do not. We're not there. And if the Nasdaq had topped in December, and you would have been in a recession at this point. So and the indications are present. So I think this is again a lot of chit chat into what is just a normal correction. Has actually been strong. And then we like to point out things that people can understand. Oh, Trump is doing this or that, and that is why the economy is now rolling over and you have a recession. Not how it's happening, and I think it's honestly just to me again a piece of getting educated all the time on how easily people are, I'll say, jumping to conclusions, but based on very few data points. So that's it. And the second part of the question again, Jesse, so was that the if we're going to see a correction, a major correction starting this year, or seeing that. I want to see now. I mean, yes, I think it's going to be this year. Absolutely, I do. And I think the last part of this rally here will resemble in the US, will resemble what we have seen in the Nasdaq, also sorry, in the DAX, also where we have seen the DAX just going up. I can't even remember how many percent it is since August 5th. And I think that you're seeing now the blow off top in some of the European indices actually playing out. And people talk about the rotation into Europe again and all that. I also think that's chit chat. You may see something of the running back to it because everything it was too high, highly focused on the US when we were in December and all that. So that the money came into the US there was because of that, because of the Trump effect or whatever it was. But I think now you're seeing somewhat of that running back, but it's not because the European markets will now start to outperform the US market. So I think you're seeing a blow off top actually developing right now here in Europe, in the DAX at least, and elsewhere also. And you see it also in the as I said, in the Chinese index. You see in the Hang Seng, and you see it also in emerging markets, which will not be something we should have seen if things were really deteriorating. So I think we're going to see that spiking up fast into the top this year, and I could still see it before summer, even though we should go significantly higher. But again, because the last phase of this, when I say blow off top, I really mean that it's going to be very steep, and then that we haven't seen in the U.S. markets.
How is your average investor out there supposed to kind of navigate their way through this, and what are the signs they should be watching for to know, okay, now the market's really starting to roll over?
First of all, it never rolls over when everybody agrees that it does. I mean, first, a bear market, a real bear market, actually comes as a surprise to people. So it's like, oh, by the way, we haven't seen a new top for some time, and actually, no, we bounced this last week, so we're all good. Oh, there was the new all-time high, it was actually lower. So it's not like it comes like what we've seen right here. And this is the problem with this decline that we have seen. It's simply been too fast. But it's difficult for the average investor, and because first of all, sentiment is so strong. Sentiment is so strong. I work with a lot of both clients and people that I meet and talk to, and they, oh, Henrik, this one you're wrong on. You're wrong on this one. I mean, you cannot be. This is the one. I mean, everybody speaks of it, and we are seeing our bankers are so bearish on it to talk about that it can decline more, 5, 10, 15% more. And if you look at it technically, well, it doesn't. It just doesn't add, and it doesn't add up if you look at the macro indicators as well. So I think it will be difficult for investors, and there's nothing else to say than you go look. I mean, the things are there. It's right there. I mean, I don't have any magic crystal ball or anything, and I think we're going to go much higher in the markets here, very soon. So look and understand that it's not when you find yourself on the same side of everybody else in X or elsewhere. Well, then you need to be cautious because most likely you're not going to be on the right side of that for very long. Then the majority of people can be right for some time, but they will not be right at the important part of times, and that's when the turning points are. Then you'll actually see like what we saw also when I saw it at a top in Tesla here, and don't want to talk the Elon Musk part of it, but just say that nobody liked that. I said, well, I think there is technically a top here, and I think we could see a stark decline, and that's 5 weeks ago or something like that, right? And or maybe 6 or 7, and now everybody can see it. So people, the sentiment is just shifting like that. So don't listen to sentiment. Go look, understand that when the yields are starting to decline, that is actually an indicator of the short-term yields that things are starting to get worse. We don't see that right now. Look at the initial claims in the economy. Do we see those spiking up? That is people coming out and saying, oh, I lost my job this week. We don't see that yet. It's at historically low levels. So why would we expect things are so bad right now? But when they start to happen, and the stock market may be at highs, and people are thinking, oh, this is just going to keep going, and we have the Fed is backing us, well, then think and look. And I mean, there are certain ways you can do it in a technical analysis, but it takes a lot of time to get and understand that. A lot of people will get, whipsawed in this setup here, because first higher, then lower, and then bounce from Fed, and then and it'll be different kind of assets you need to be in. So extremely difficult to navigate.
Navigating the financial markets has never been easy, but in times of uncertainty, the challenge becomes even greater. History shows that true market collapses rarely happen when everyone expects them to. Instead, they unfold subtly, first with signs that many dismiss, then with a sudden shift that catches the majority off guard. As Henrik Zeberg explains, the current market sentiment remains overwhelmingly bullish, with investors confident that any dip is just a temporary correction. But it is precisely in these moments, when consensus is strongest, that caution is most needed. A key factor to watch, according to Zeberg, is not just stock prices, but broader economic indicators. Yield movements, initial jobless claims, and shifts in investor sentiment can provide early warnings of an impending downturn. Right now, these signals remain stable, reinforcing the idea that markets have more room to rise before the final top is reached. However, when short-term yields start falling and unemployment claims begin to spike, the tide could turn quickly, catching many investors off guard. Those who rely solely on the prevailing market sentiment rather than hard data may find themselves on the wrong side of history. As markets reach a tipping point, the structural weaknesses of the global financial system could come into full view. The debt burden carried by nations, corporations, and individuals has grown to unsustainable levels, making a traditional recovery increasingly difficult. When the current financial order begins to falter, the need for a monetary reset will become undeniable. Historically, such resets have been anchored in tangible assets, and gold remains the most likely candidate to restore trust in a new global currency system. In the past, gold-backed monetary systems have provided stability in times of crisis, and as confidence in fiat currencies erodes, a new framework, potentially involving a basket of currencies backed by gold, could emerge as the next phase of the global financial order.
I'm not an architect of these things, but I can only look to history and then say what is it that we potentially can see. And if you are in a situation where the entire system has become either fraudulent or very speculative, or it is right now, or and just so indebted that it's impossible for the entire world to pay out its debt, ever pay its debt, and we start to see interest rates going up, and you'll see the commitments and the on that on the payments for people and for nations around the world. Well, then you will have to see some kind of settled. There'll need to be some kind of settlement there, and the only way we actually can see that you had a situation like that in after the Second World War, where the debt levels were at comparable levels to what we see now. There it was quite kind of easy because you had the one nation standing out that had half the production of the world and also half the gold in the world. So the US could step forwards and say, well, we put the US dollar here, the greenback, and we back it by gold, by the way. And, nobody could really say no to that at this point. So it was a fantastic situation for the US to do that. At this point, we have seen how the dollar has been weaponized also, and there are a lot of countries around the world trying to fight that. China, Russia, and so on. And it is the very core of the strength of the U.S. Hegemony, the state of U.S. Right, because they simply, if there wasn't this demand for the dollar, you would have a completely different situation in the U.S. And I think that we are seeing so many flaws and problems with that whole setup now that it will come to an end, and the whole debt problem will come up, not in the first phase of this where we see deflationary development, but I think down the road when we come into a stagflationary period, when inflation is running high and you really do not, you can't do anything about it, you can't stimulate your way out of inflation, and the economy is still stagnating. Well, the only thing there is left for the countries in the world to do, or the administration around the world, is to create sound money. And that sound money will take, a reshuffling, a redoing of how is it that we see the world currency? Is that going to be the dollar? There will be a lot of challenge to that now in the future, because people say, yeah, but we actually did see how you misuse that strength of that. So we probably want to be part of that as well this time around. And the U.S. doesn't have the half the production of the world now, and doesn't hold the half the production of the world's gold reserve any longer. So it will be another kind of setup, and I think the monetary reset that we talk about here down the road, 2 years from now, who knows, will be something where we'll see kind of a basket currency come out, a world currency consisting of a basket of currencies and then backed by gold. I mean, it will be the most natural thing to do. I don't think Bitcoin will have much to do with that world. I have to say, I think that it's a dream for Bitcoin, and maybe I'll be proven wrong, but I think gold will have a lot of that. So I think at the core of that kind of basket, which may have a digital element. So think a world currency of a which has a digital element to it, which means that the checks and balances can be kept. That's what we can use it for, and then backed by gold. That is what I think will be the I think will be what the primary. I mean, the Western world will try to establish, and I think we will in the Western world be successful in doing that, even though there will be some yeah. Opposition again from the BRICS countries and others, because everybody knows that whoever holds the reserve currency or this, and even though it's going to be spread out more maybe on the Western world there, and also with China and everybody else if they want to join in, but in a Western dominated kind of setup, well then it's probably going to be again still a Western kind of system that will be dominating in the future as well. So I think the whole thing there is more geopolitical, and it's based on that we are seeing a lot of bad things coming out of the system that we are now been having in place for so many years. And there will need to be some kind of solution also because of the debt also we have. So the monetary reset, that's what I think about that. That is what I see there. And it's a bigger thing. It's we have to think it's like what we saw in Bretton Woods in 1944, kind of reset of things, and magically we can then also write off some debt and so on and so forth, and it'll be a nice thing. People will it's like it's not magic, but really it is just a giving up on debt for some people, or forgiving debt, and then it will be for people, but also for nations, and you will have a fresh start. And that is what the world needs right now. The world needs something. They need sound money again, more than ever. We need sound money, and I think that is the monetary reset. But we are, some distance, some way from that yet, because we need to have the administration to understand that's really the problem. And then you'll see that even though, and I think the goal is there. I mean, I don't wear a silver foil hat here. I think the goal is there, which kind of have said that they hold, and then it will be okay. Now it's not at this price any longer. It's like this, and you'll still see that will only be a small part of the U.S. Debt. So it's not nowhere near that level. So it will be a bookkeeping kind of exercise, which is long overdue, and then honestly, that's it. I mean, it will I mean, it will start to trigger some questions about the future of gold also, and why if it's not that important, why would central banks still keep holding it? Why, if it's not that important? So I think it's doing that may trigger some questions also down the road, that why, if it's not so important and everything else, why don't we just sell it then? I mean, why to get rid of it and then pay off some debt with it? So I think they may do that. I think it's overdue. Why not? And then also reprice it at the current levels, and then have an understanding of what and that can have that will have some bullish effects also on it. Obviously, I mean, it was kind of recognizing that gold is in appreciating in value, and can probably also do that in the future and all that. But I think it's more of a bookkeeping thing than it's a real thing.
As the global economy faces mounting pressure, the possibility of a financial reset is no longer just a theoretical discussion. It is a reality that central banks and policymakers will have to confront. The era of easy money, excessive debt, and artificially suppressed interest rates has created an unsustainable financial system, one that will require a drastic restructuring when the next crisis unfolds. While the exact form this reset will take remains uncertain, history suggests that trust in monetary systems is ultimately restored through tangible, universally recognized assets. Gold, with its long-standing role as a store of value, is likely to be at the center of any new financial architecture. For investors, the key takeaway is clear. Ignoring the warning signs could be costly. While markets may continue their upward trajectory, for now, the underlying structural risks remain unresolved. The shift from speculation to crisis often happens faster than most anticipate, leaving little time for preparation. Whether through sound investment strategies, diversification, or a deeper understanding of macroeconomic forces, those who position themselves wisely may be better equipped to navigate the turbulence ahead. If you found this analysis insightful, don't forget to like, share, and subscribe to the channel. Turn on notifications to stay informed as we continue to bring you expert insights on the evolving financial landscape. Join the conversation in the comments below. What do you think the next monetary reset will look like? Will gold play a central role, Or will digital assets take the lead? Let us know your thoughts. Thanks for watching.